Hi there, it's Hal Feldman, MiamiHal. This is the MiamiHal Real Estate Show, and it's a special episode 22. That's a family number. It's always lucky. And I'm lucky to have a friend of mine who is here, Marcell Hetenyi. Welcome to the show. You're one of these smart and funny guys that I love to get around and be around. On top of that, I have you here today because you're a CPA. So looks like you've just been through a very heavy season of tax prep, but you look rested. You look good.
Thank you. Thank you for having me. And yeah, I'm starting to get rested. It was a rough tax season, but we got through it.
Good. So we're here today to talk to you about what is going on with people's finances. And of course, you have got a general overview of what all kinds of people are doing with stimulus money, how they are getting along with their taxes, and how that potentially relates to real estate. Because as you're aware, the real estate market is absolutely bonkers right now.
Mm-hmm.
And as we talk about a pendulum swing, we are way, way over on one side of the pendulum swing to sellers having a distinct advantage in this marketplace. So I wanted to spend an episode talking to you about the things that matter to people. And of course, right now, we're just coming out of a late tax season, right? So talk to me about how people are coping with filing later personal return and how things have gone for you.
Well, I guess to answer the second question, that's a little bit easier. Things are going okay for us, fortunately. As you know, the two things that are for sure are death and taxes. So that's comforting when it comes to my profession. But in terms of people, well, look, I don't know if it was necessary to extend the individual tax deadline, but they did, so we have to roll with the punches. I find that most people, even if you give them 4 or 5 years to file, they will only wake up about 2 weeks before the filing deadline, no matter what.
And then file late.
And then some of them may still even file late. Yes. Correct. Especially most people don't really understand that the extension is only an extension of time to file and not an extension of time to pay. So you still have to pay your taxes by April 15, or in this case, it was May 17. So, but everybody's different. There's some people that line up at the door, February 1st with all their documents, although that's rare. Most people tend to go, close to the deadline or right up to the deadline. At least that's our clientele. I'm sure everybody else has.
Which of course squeezes you. Meanwhile, let's talk a little bit more about your practice, because I glossed over that. You're a CPA by trade.
Mm-hmm.
And you work with your father-in-law,
correct?
Mm-hmm. And you've got an office or offices where?
I do work with my father-in-law. He's Martin Schechner. He's a legend in the industry, has been a Miami CPA since the 70s, although he's now finally retiring and starting to enjoy life. We have 2 offices, one in Palmetto Bay. That's our main office in the Palmetto Bay Village Center, the old Burger King headquarters, for those of you that are more familiar with that. And then we have another office in the Gables that's primarily to meet people, some people that come from the beach or other northern areas of Miami. It's easier for them to meet us in the Gables. So,
and it looks like you got business happening right now. So grab that phone and just put it somewhere where it's not going to buzz on the microphone for us. That's perfect.
There you go.
Quite all right. So what I wanted to really understand, because real estate, I can talk about real estate directly all day long.
Mm-hmm.
And I really have a pulse on what's going on because I do it all day, all day, every day.
Yeah.
But money is very important to the process of real estate, as you might imagine. And you're seeing money from a slightly different perspective. You're watching people's incomes, which I think generically you can probably talk about. Obviously, we just had a full year of COVID affecting people's livelihoods. And I'm wondering if, in general, can you kind of talk about, hey, people made about the same as they made the year prior? Was there a real effect in general income? And then how is that potentially going to affect people when they're looking to do something as big as real estate?
Well, as you probably know, the Miami real estate market is kind of unique in the world in that we not only have the locals that buy places here, but every rich person in all around the globe has a place in Miami, whether it's from South America or from Europe or whatever. So we are not just looking at the locals and what the locals can buy and the locals can afford. It's really a very international market, which of course affects our prices also, what you and me pay for a home that
Sure.
everyone live in,
Yeah.
that they may just use to invest. The last few years, there was an awful lot of foreign money coming in and buying, mostly on the beach and condos and whatnot. In the, I live in Palmetto Bay, you live in Pinecrest. In that area, obviously, that's not so prevalent for foreign investment. It's more so the touristy areas. I have found, obviously, during COVID that part slowed down, since people didn't really have the ability to come here and take a look at the condos and just invest their money. They may not even have had the liquidity to invest. But in general, for the locals, at least the part that I represent, which is not that large portion of Miami, certainly, it's a huge city. It looks like most people weathered the storm reasonably well. Insurance agents were obviously banking big time, since people rushed out there and bought life insurance real fast. Attorneys, it seems like the legal disputes didn't seem to slow down too much. Doctors were obviously doing really well. So most of my clients are in the service industry, and they all weathered reasonably well. There was a slow period, though, the March, April, May 2020, it was kind of slowish for everybody, but then it picked up and made up for whatever it lost. Certainly, there's certain industries that I don't represent, like restaurants. I would imagine, I don't have a restaurant client, I don't represent them, but they certainly had a very different year than most service people would have had. Even manufacturers probably had a slightly different year. I also don't represent anybody in the airline industry. I would imagine they also didn't fare so well. But I do represent some people in the cruise industry, and I guess the cruise companies had enough cash that a lot of their employees and a lot of the people that work for them continue to do reasonably well. I have a client that fixes cruise ships, and I guess the cruise industry decided it's a good time during the downtime to fix some. So their business continued, although we were worried for them.
Our hearts go out to them. Obviously, anybody that was affected. But now that we're through an individual filing deadline, and people are either seeing a refund or obviously making payments, as the case may be, do you find that more people have gotten refunds as opposed to owing the government? Where are we with that? And is it an inflow or an outflow in general?
Well, okay, so I first want to clarify something, because a lot of people have that misconception of, some people judge the ability of their CPA based upon how much money they can get back, or they just kind of count on that. Well, obviously, how much you get back or whether or not you get anything back is really a factor of how much you paid in. If if you haven't paid in, or if you haven't paid in enough, then certainly you will not get any money back. And also, it is a huge difference between regular W-2 wage earners and people that have a business. Because obviously, if you are an employee and you work for somebody, then your taxes get withheld. And yes, you have some control over it, but not so much. If you own your own business, then of course, most of your money isn't made through a basic salary from a W-2.
Right.
It's made through the profits of the business, on which there is no withholding. So, and that's the majority of my clientele. So most of my clients usually owe money at the end of the year, because although we try to do our best to estimate it as closely as possible, if they have a great year, they're going to end up owing some money. The bigger concern is whether they have the money available to pay in, rather than whether or not they owe. And that varies. There's some people that, don't bat an eye when I tell them that, hey, you owe $400,000, April 15th. And of course, there's some people who panic on a $7,000 bill, not necessarily because of their income. It's also some people save more than others. So, for example, when it comes to real estate, it's a great form of investment. But it is, as you know, somewhat illiquid. So it can get people in trouble financially, because I have seen, especially in 2008, 9, 10, around that time, a lot of people spread themselves a little bit too thin in real estate, and then they didn't have the liquidity. But now I don't see that as much. Now, the locals, at least, I see people have concerns of, obviously, they would love to sell their house and cash out, but then where do they go? It's okay to sell your house and get a large amount, but then are you going to rent for a couple of years? Or because it's not even the fact that housing prices got it more expensive, it's the fact that there is no inventory. I know I'm not breaking any new grounds here for you.
Right.
The lack of inventory makes it very difficult to find a replacement house even if they have the means to buy another one.
You know, I just wind you up and you go. So you answered a couple of questions I didn't even ask yet.
Sorry.
But that's quite all right. But let's actually assume a situation and see how you would give advice. So somebody says, listen, it's a great market. I want to sell my place, and they do.
Mm-hmm.
And we'll just come up with a random number of $1 million that the house gets sold for. So obviously a large chunk of change is now received by a seller. They pay off whatever mortgage they have, and they've got, again, still a sizable amount of money. How would you, as a CPA, prepare them for that year's tax return, and what kind of guidance and advice do you tell somebody that has a lot of money that probably wants to go and spend it right away, right? What general guidelines would you give somebody like that?
Okay, so there's two important things that I want to point out there that I find people misunderstand regularly. Your gain on the sale of a property is the difference between what you paid for it plus any improvements minus the sales price.
Right.
Some people think that, oh yes, I sold it for $1 million, but I paid off a $600,000 mortgage, so really I only have $400,000. How you financed it and how much you owed upon sale doesn't really matter for purposes of the gain. It's just strictly a factor of how much you bought it for. Doesn't matter how it was financed, plus the improvements, and of course any cost of sale, commissions, and so on, minus the sales price. And then the second big question is what type of property it was, because if it was your personal residence, then the first $500,000 is excluded, so long as you haven't taken advantage of that in the last 2 years.
First $500,000 of profit.
Of profit,
okay.
Correct.
Okay.
Which here in Miami is not always plentiful. You know, most of the rest of the country, very, very few people probably have to worry about it outside of like New York, Los Angeles, Miami, and so on. You know, you go to more of the middle of the country, a $500,000 gain is sizable. Is a very sizable gain. So unless you held onto the property for 10, 20, 30 years, it's unlikely that's going to be an issue for you. Here in Miami, it doesn't take a mansion to have a more than $500,000 gain on your personal residence. So that obviously is a big factor, but it can eliminate an awful lot of taxes for people on their own home. If it's an investment home, whether they just bought it for rental purposes or any other type of investment, then of course gain is taxable from the first dollar.
Got it.
And then the advice really all depends on you know, how responsible the client is. Some people I know that they're going to have the cash at, you know, next April, and they may even have some short-term investment that they can put the money into to make a little more of it. That's great. Some people that are less responsible, I immediately advise them, no, put the money aside, or preferably even let's just pay it in. I know you're giving the government a 0% APR loan, but it beats the hell out of having to pay penalties and interest when you don't have the money the following year.
And I think you've said a couple of times that you're there to give guidance. You cannot turn a magic switch and get a tax return of $10,000, a refund, I should say. And so your job really is to be an advocate for your clientele and to understand their personalities, and then help them adjust their potentially a little bit wild side to making sure that they're covered when it comes down to what the government's going to ask for at the end of a year.
Oh, absolutely. I think part of standard accounting training should be a little bit of psychology training, because really a lot of what we do, I mean, most people think I just deal with numbers, and yeah, there's some numbers involved, but so much of it is just writing emails and communicating with people and consulting. You know, figuring out the tax amount on a sale of a real estate is not that difficult. Relaying that message and doing all the consulting related to the client is a lot more difficult. You know, some people obviously most people don't want to pay tax, but some people accept the fact that taxes are there. Some people get really upset about it. And of course, they cannot go and complain to Congress or complain to the government. So I am the punching bag. They want to complain to me. And, you know, not to get political, but many times whoever is in administration at the time is the one that gets blamed for one reason or another. It's their fault.
Thanks, Obama.
Exactly. Whether it's Obama, whether it's Trump, whether it's Bush, whether it's Clinton, it doesn't really matter, because most of the time it really isn't a factor of that. They're just angry and they want to be angry at somebody, and somebody who isn't there to defend themselves. So it's me or the government at the time.
And in real estate, it would be somebody like me. So
or in real estate,
we have a similar pattern with our clientele.
Correct. And so depending on who the client is, and that's where knowing your client becomes very important.
Sure.
You kind of approach it from a different angle, and that's where if I know that the client is a big spender, I advise them to just put the money aside now. If
Makes
not,
sense.
I can. So we can kind of work out a most suitable solution. And we can also figure out what else they can invest it in. And nowadays, there's an awful lot of options with the qualified opportunity zones or a 1031 exchange. There's a lot of different ways to reduce or potentially eliminate the tax consequences from a sale of a real estate.
Got it. So before we shift our focus, I'm going to look out at our audience and remind them that we are live right now. We are monitoring if anybody has any questions. Now, we don't want to get into too much of specifics, but if you've got a general topic that you want a CPA expert to be, giving you some general guidance on, we'd love to see those questions come in. And I remind people that even if we are being played back on demand, ask those questions anyway. We'll dive back in and try to answer those for you on demand as well. Let's talk.
We'll do a part 2.
Exactly. So let's really dig into real estate. And I'm looking for your personal opinion here. And of course, there's a professional level to what you're seeing and explaining. Do you believe today, with what appears to be highly inflated prices and a very excited volume of people trying to purchase, is now a good time to purchase real estate for residential purchases?
Well, look, this is my personal opinion.
That's what I want to hear.
And this is not my opinion as a CPA necessarily or as a financial advisor. And I believe my opinion matches that of most other realtors, which is for your own home to buy. Anytime is as good as any. I certainly prefer to pay a mortgage than rent, so paying somebody else's mortgage through rent. I myself have some rental properties, and most of the time the rent more than covers the mortgage payment and then some. So not counting potential risks of a new roof or a new AC being needed, those people renting would be better off paying a mortgage on their own. So again, for your own personal use, it's always a great time, because if you love the place where you live, it doesn't really matter what it's worth. I bought my very first home in February of 2007. As we know, 2018 didn't, pan out as well as we all planned. And actually, even 10 plus years later, I sold that home for a little bit of loss, even at that time. But I don't regret it. It was my home. And
you get enjoyment. So one of the things I was told when I was younger, and I repeat it to all of my clients, is buying a home is like living in your bank account. And so there is truly enjoyment there that often cannot be figured out by dollar figure. If you spend 10 years somewhere and you have this love and family and enjoyment of the home, what value can you put on that? It's priceless, right? That's the MasterCard commercial or whatever. And so in addition to that, you of course are hoping that you'll have some financial gain when you do exit. But so your general advice is, if it's your primary home, go for it, right?
Correct. I mean, that's, I never heard of it being put as you're living in your bank account. I kind of imagine Scrooge McDuck diving into gold, but
I'm all for that.
But yes, I believe for your own home, it's never a bad time to invest. It will also help your credit, because you're building loan history and so on. You're learning budgeting. It's always it's really, really hard to get really, really badly burnt, especially if upon the exit if you're not in a hurry to move anywhere, you can just wait out the market and wait till it goes back up. Very few people are ever forced to sell a house urgently, unless they happen to get a job outside of town or something along those lines. And even then, they can turn it into a rental real estate. Advantage being is then after a few years, it will become rental property and the loss will be deductible. Now, if we turn it around and we say for an investment purpose, obviously for investment purposes, there unfortunately is always a wrong time to invest. But knowing what that time is very, very hard to tell. Even now, if you go out and ask people's opinion as to what they think the future holds, there's about 50-50 split. Some people think, okay, it's going up, but it will maybe slow down in going up, or level off, but it will not go back down. Some people think once, the New Yorkers that are supposedly right now making our market crazy by moving down after a bad experience with COVID, once they realize, okay, this is too hot here, too humid, we don't like the Julys in Florida, let's go back to New York, then the market will crash. Short of a crystal globe, and mine is freshly broken, I can't tell you that. There's always a risk. But even then, again, given a long enough time horizon, you will be fine.
Yes. Just like the stock market, if you wait long enough, you're in the market or in the housing market, as the case may be, over a course of 10, 15, 20 years, you really are very unlikely to go wrong.
Correct.
Corrections, sometimes a scary correction, yes, but over time, investing in real estate is one of the best investments you can make. Do you agree with that?
Yes, it's certainly up there. Again, other than the potential issues coming from its illiquidity, it is a very good investment. And unlike stocks that may cut dividends, or you're correct that even stocks will eventually recover, but they may cut dividends and so on. If you have a rental property that's continuing to provide you rental income, then it doesn't really matter what the value is doing, as long as your rental income covers your expenses
and you're generating some
and you're generating cash flow. Then it's golden. And then the value really will only come into play if and when you decide to cut the goose that lays the golden egg and you decide to sell it.
Yeah, the statistics, by the way, are New Yorkers to Florida, not Miami specific. The influx is about 22% of the sales that happened over the last year are to New Yorkers, and 12% are from California. This is an interesting way to look at the market and understand that 34% of the sales that are generated in Florida, which is artificially way high compared to history, are from those two states.
But just for the New Yorkers out there, the general public believes it's 100%. So
that's true.
It's not correct, but
and the price tag keeps going up.
Correct.
And I talk about this with other real estate agents. Just wait until the New Yorkers, who can make it anywhere, right?
Yeah.
Until they go through their first hurricane season.
Correct. And the first July with 98% humidity and whatnot, and the first hurricane season, it will certainly be a very different. I hear they're even opening up restaurants for New York flavors, and it's interesting to see how that's gonna survive.
Do you have conversations with anybody that you just finished a tax return with, and they're like, I feel comfortable about how we're exiting the COVID-19 situation, and I do want to invest in real estate? And have you given them advice as to how they might approach that? And I know it could be very individual, but in general terms, anything you can tell us?
Look, in general, and this is not specific to real estate. In general, I find that people are optimistic about the future. We know we are obviously nowhere close to being done with COVID, but we are on the way out. There is a light at the end of the tunnel. Hopefully, international travel will start back up very soon, and hopefully things will normalize to whatever the new normal will be, which none of us really understand in terms of how much face-to-face interaction will return. We are both a member of and on the board of the Palmetto Bay Business Association. We started finally having some face-to-face meetings over the last couple of months. I had my first few business lunches in over 18 months. So we are not going to be stuck with Zoom forever, but Zoom is also not going anywhere, meaning there's going to be a lot of Zoom interaction, and a lot of travel will be replaced by all of those. So there will be certainly a change to whatever the normal is. But I find that most people are optimistic about the future. Honestly, what is, and again, I'm trying very hard not to get political, but what has been scaring most people is all the news about the potential increase in the capital gains rates, whether it's pertaining to selling a business or selling a piece of real estate or whatever it may be,
or stock,
or stocks or whatever. I usually tell them, I think it's Mark Twain that said that I've been worried about a whole bunch of things, most of which never happened. So currently, I would not lose sleep over or panic about some hypothetical that may or may not become reality. And if it becomes reality, we don't know the details under which. There's going to be exceptions. There's going to be ifs, ands, buts. It's never just like flat, this is what's going to happen. So most people tend to be concerned about that. I wouldn't make any rash decisions based upon a potential increase in capital gains rates or a potential decrease in the estate tax limits and so on. So outside of those two things, most people seem to be very optimistic about the future. Certainly no talks about a recession coming or anything along those lines. They think business will only improve. And if we just go and look at the line at Home Depot, I can only agree.
Speaking of Home Depot, one of the factors, certainly not the factor, but a factor in why we are not seeing, enough inventory to really satisfy the market is that building supplies. Mm-hmm. Now, Home Depot is at a much more individual level, but still the prices of a piece of plywood have gone from $22 to $60.
Correct.
Some things have only gone up 20%, but there is a tremendous amount of pressure for builders. I'm working with a client who sold here in Miami and is now more central Florida, and she put in a contract on a house that was to be built, and it was supposed to be built about 8 months ago. And we had all kinds of problems communicating with that builder. And ultimately, the builder fessed up and said, listen, we would really love to deliver a house for this woman, but our margins have shrunk down to about 3% because of the cost of building materials. So we're really seeing a multifaceted change in how the housing market is operating. And then people are going to have to react to that. I assume that's the same in kind of tax code every year. There's some changes and everybody's trying to adapt to avoid as much tax as possible, right?
Correct. And every year, and just like with the housing market, with taxation also, perception is a big factor in terms of what people think is the situation, whether or not facts back that up or not. So that's why whether people are optimistic about the future or pessimistic about the future is a very important element in any decision, because, well, as sad as it is, facts don't always come into play. But yeah, in this case, certainly there is no doubt about the fact that a piece of plywood, went up. There's all those memes about, I'm willing to trade a antique Porsche for a piece of plywood, and don't try to lowball me. I know what I got, and all of those things.
Finally, a little bit of humor came out, because usually when we're not on camera, you and I just crack each other up all the time. Mostly it's you cracking me up.
Yes, but yeah, I just got to be careful with my language, because I also tend to sometimes.
You use a little salty language.
Yes.
Well, in the last couple of minutes that we have, I really want to highlight the fact that you are a very personable CPA. You're not one of these guys with the green visors and just leave me alone. And your business really is, as you explained earlier, about understanding the personality of your client and adapting to that. So, you just came out of season and you want to prepare all of your clients for next year. Mm-hmm. So I'm going to give you the floor, take 2 or 3 minutes, and just say some bullet points as to what people should do to make sure that they stay on top of their finances and ultimately have an easier tax return for next year.
Well, obviously, again, that's not just in my field, but preparation and proactiveness is always a key element. So, for example, when you have any major transaction happening, even if something as simple as buying a car, but certainly buying or selling a house, especially an investment property, mm-hmm. Let your CPA know when it happens. Don't drop that bomb on them April the following year saying, hey, by the way, here's the closing statement for my house that I just sold for a $2 million gain. A lot of the planning options, kind of the doors close on December 31st. So it becomes very, very difficult to plan, or not very difficult, but a lot more difficult to plan after the year is closed. And so all of that information, and I think most CPAs don't necessarily mind being piecemealed. I mean, don't send me 10 emails a day. That's a little too much, but certainly getting, 6 emails per client for each of their larger transactions is not the end of the world. When I prepare the return, I can go back, or really when we do planning in November and December, I can go back, read those 6 emails and figure out what happened and figure out how we should plan for that. The other big advice I can give to any body out there who does tax returns or who has their tax returns done is either get it done early or just let it go on extension. You don't want to be the one that gets prepared on April 12th. We are all humans. We all make mistakes.
When you rush,
and
yes.
when you rush, so if you cannot get your stuff together, then just allow your CPA to just do the basic to make sure you have enough paid in, and let them finish the return in May, June, July. Don't force them to finish it by April 15, because that's when most mistakes happen. We try very hard not to have any mistakes. We review every return at least twice, and most other CPA firms do it out there. But when you're short on sleep and you're hungry and tired and just can't wait for that day to roll around, mistakes can't happen.
Got it. Marcell, he's the second name in Schechner and Hetenyi.
That's me.
They are in Palmetto Bay primarily, also have offices in Coral Gables. And you help people manage their assets and their money and making sure they pay the government their fair share. And ultimately, that can help them achieve real estate dreams. So I appreciate you. Thanks for coming by and giving us the advice and the insight that you have. And certainly, we'd love to have you back again.
Thank you for having me, and I'll be happy to come back anytime.
All right. Until next week, this has been an episode of the MiamiHal Real Estate Show. Have a great week.